This week, we're speaking with a national chief economist for a major real estate company, and we're going to be talking about what we should be expecting with regard to interest rates going forward, what's going on with Canadian demographics, with the housing market, with the dollar. If you want to get a good handle on what to expect in 2026, you should really stick around to listen to hear what he has to say. This week,
This is
we're
Make
speaking
Better
with
Wealth
Carl
Decisions,
Gomez. He
a
is the chief
podcast
economist
dedicated
and
to helping
executive vice president
pre-retirees
for
and
Centurion
retirees
Asset
manage risk and
Management. He also
economic
holds an
uncertainty
MA in
by
economics from the
adopting a
University of
pension-style
Victoria.
approach to
We've
improve
recently
your
had
risk-return
his
trade-off.
CEO on a couple of
I'm
times,
your
so it's
host,
a pleasure
John
now to
DeGuy,
speak with
portfolio
Carl.
manager
Get
with
his
Design
take on
Securities
the
in
way the world is
Toronto.
evolving in 2026. How are you, Carl?
Great. Thanks very much for having me, John. Looking forward to our discussion.
I want to begin by offering some little bit of some news, some personal news on my end. My wife and I just bought a home. And so here we are in the late first half of 2026 in the west end of Toronto. Was that a wise decision, or were we perhaps doing something that was a bit reckless?
Well, I hate to give generalized answers to that. I mean, a house to live in is certainly a lifestyle decision. And first and foremost, if that's something you need, something you need to have for your lifestyle, that's absolutely the decision. If it's an investment, on the other hand, and some people look at their homes as their only investment, but if it's part of your investment, then it's a different story. And we can get into details on that for sure.
So what I was asking was, and I wasn't trying to get you to put you on the spot too much, but I'm curious because Centurion works with private real estate. I'm wondering, I guess, broadly speaking, about where you think we are in the cycle in terms of what your expectations are for, let's say, interest rates and by extension, mortgage rates for the remainder of 2026, and what the general outlook is for residential real estate for the foreseeable future.
Sure. I frame this in a lot of my presentations as a bit of a reset from what we've known for the last 20 years. And one of the big resets really stems from interest rates. We've seen, a secular trend of interest rates going down for 30 years. That's pushed up people into the housing market, made the cost of ownership really great. But, since post-COVID period, interest rates have reset. Inflation is back on the table. And although interest rates aren't that much higher, house prices have been. And so affordability on the ownership side has deteriorated considerably. Without the wind at the back of lower interest rates, it takes people a lot more in terms of getting into the home ownership market. So our view is basically that we are in a reset right now as the house, cost of housing needs to come down to a point where affordability is great. And as a result, that record high home ownership rate is now starting to come down as well. We pushed it to some of the highest levels in the developed world, even higher than the United States. And I think as a result of that, we are starting to see a secular force towards renting as an option for people where they live. It was starting, during COVID, but I think we're in the beginning ends of a secular shift back towards renting. And so our view is that just when you do the basic math and look at the cost of ownership versus the cost of renting makes a lot of sense.
But you never really answered about what you think about rates. What do you think is going to happen with interest rates for the remainder of 2026 and by extension, mortgage rates?
Yeah, so great question. And again, I'm an economist, so, I'll give you my standard economist answer, but at the end of the day, nobody really knows where interest rates are going. But one thing I can say from a fundamental standpoint is that rates have reset. I think they're going to be range bound, at least in Canada, because the Bank of Canada is anchoring, interest rates on the fixed side, the long-term rates down. But that said, there's a lot of volatility in the system, and, particularly in terms of inflation. And so if you look at the United States, and obviously our fixed rates take a cue on US fixed rates, Straits of Hormuz, the risk on the oil side and bleeding over into inflation could push rates up a little bit higher. And so I can't speculate, where that deal goes. But I think in the interim, I think rates are going to remain largely range bound. The 10-year government of Canada, which is the benchmark that I look at, 3.5% is pretty much where it's been for the last 3 years, but then it goes up or down depending on where people see inflation. My view is it's going to probably stick there. As far as where the Bank of Canada goes, and I've been kind of adamant about this outlook, is that the Bank of Canada is behind the curve. It's reacting to the market. If you listen to what they're saying, they're still very concerned about inflation. It's their only mandate. And so I would actually say that after very big cuts and holding steady at 2.25%, that the Bank of Canada is likely to remain on hold, but for inflation risks. And if those inflation risks continue to come back, I think their next move is solidly higher, which means that we've reached the bottom of this rate cutting cycle. So that's kind of my view.
That was the answer I was looking for. I've heard you present, and you're a great presenter. And you were speaking recently about demographics, and it is one of the things that I believe people oftentimes overlook. They look at capital markets and profitability and so on and so forth, but a lot of investors fail to take a look at the big, larger macro picture, which is just the state of the way the economy is moving as a result of the pig and the python, or the boom, bust, and echo, or whatever sort of metaphor you want to use for demographic cycles. What are your thoughts on Canadian demographics as we head into the second half of 2026?
Great question. And I'll frame this in the sense that, when you invest in real estate's a long-term investment, and it really is shaped by the demographics. And I think there's two major themes that are happening on the demographic level. One is the fact that we can't deny it. There's the aging of the baby boomers, and they have dictated what's happened, generally speaking, in the housing markets all along. That being said, they're also holding on to a lot of equity that they built up in their houses and the stock market portfolios for the last 20, 30 years. They've been a big beneficiary of that. And to some extent, because we kind of held back the ability to make new single family detached housing, and they're the ones that hold most of it, there's a lot of equity supporting those prices. So I think they're going to be using that equity that they have, for inheritances to pass down to their kids, to make sure that they can stay in their home longer, use it to kind of fit out their homes, for rising healthcare costs. So that's a big demographic trend that I continue to see perpetuating a wealth divide, I think, in Canada, but also the United States. This is a trend in most of the developed world. The other major demographic factor right now is the fact that Canada is coming off a very robust period of international immigration. A lot of that was from non-permanent workers. There's been some correction in that because of bugs in the system. That's slowing down the rate of population growth, which really pushed all sorts of things in Canada, whether it's consumption spending to housing to renting. And we're in a bit of a transition in that. Our long-term view is that population growth, particularly from permanent immigration, will remain a big driver of the Canadian housing market, and the economy per se, because we're just not making babies anymore. But the reality is that's going to continue to be a tailwind on housing demand. And whether that's ownership or rental, it really depends on, as I meant, the trade-off between, what's more affordable. But one thing I will say from a demographic standpoint that I'm looking at is a lot of the kids of the baby boomers and younger, Gen Xers, not Gen Xers, but the Gen Zs, the Gen Alphas coming up, they don't believe the same dream that the baby boomer parents and grandparents believe. Homeownership was the way to wealth. And what we're seeing, if we just look at TikToks and Instagram, is a lot of young people saying, and this is also related to the way they work, where work is a lot more flexible, that homeownership is more of a noose around their necks. So it's our view that changing demographic situation, also the aging baby boomers, population changes, really shifts the long-term outlook towards renting. And look, this is not a Canadian phenomenon. Europe has been doing it for years. We're just kind of catching up.
I'm just wondering about the fulcrum of what we were seeing in capital markets. We're seeing traditional stocks, equity investments hitting all-time highs, whereas real estate in Canada has been soft and dropping more or less for the past 3 or 4 years. When is that fulcrum going to shift? When is real estate going to hit a bottom, and when are stocks going to hit a top? And I'm not asking for a date. Maybe just a rough time frame, a scenario. In your view, when will the worm turn so that real estate sort of, okay, now people are now comfortable with real estate, and people are increasingly uncomfortable because they haven't been up until now with regard to equities?
Well, I'm not an equities guy per se, but one thing I will say is that when you look at the stock market and you look at valuations, they're very stretched. Pricing is kind of disconnected from earnings. And a lot of what's driving the stock market right now, in my opinion, has been expectations of very strong earnings for a select group of companies. It's very highly concentrated on, the AI sort of tech sort of world. whether those, expected earnings will actually materialize long term. And that's what's really driving it. You look at SpaceX, key point, there's a lot of hubris and euphoria around that. So I'm a little concerned about that. But my general takeaway, when I look at real estate, look at stocks, is that it's all about the earnings and it's all about the earnings potential. What's happened with real estate right now is because of the reset in the cost of capital, it's forced a lot of people to say, look, the valuations are right now, can the earnings support that? And I think there's a lot of headline risk around real estate because we've had such a bull run over this period of time that some correction and what I call a reset was necessary. And a lot of that sentiment and an illiquid asset class like real estate is still holding it back. And real estate, as I mentioned, is long-term investment. We don't need the liquidity. So what you're seeing intertemporarily right now with a lot of that kind of, noise and market risk, that's kind of volatility, don't pay attention to that. Pay attention to the earnings. The same advice I would talk about with stocks. And if you look at that long term and you look at it selectively, on real estate assets, where they are, all of that sort of stuff, I believe that's really, a solid investment long term. One thing that we've been spoiled with is because of the secular decline in interest rates over the last 20, 30 years, we've seen big valuation effects, right, in real estate, and that's a recalibration. And people were less concerned about the earnings growth, call it the income ability to generate income growth. And in this cycle with interest rates, to me, not being the wind at the back of real estate, it comes back down to that earnings growth. And with real estate, you have to do something different than beta, which is just following the market. You have to do alpha and mine growth out of that. So that is a very important distinction in this cycle, in our view, is that good managers can mine earnings growth and income out of real estate, but it takes patience and time to look away from that volatility as well.
Because you're a chief economist, and I don't usually have chief economists on the podcast, so I get to ask you questions that I don't usually ask others. I want to talk to you about the dollar. Do you think there's a reasonable chance the dollar might drop below 70 cents? And if so, why or why not?
Great question. I've been a dollar bear for a while. And one of the major reasons, the Canadian dollar bear, has been, if you just look at the long run rate of productivity growth in Canada, we have not been productive. Going before 2015, the Canadian dollar was looked at as a petrol currency, and it would actually follow the price of oil. And we all know what's happening with oil these days, but the Canadian dollar is not reacting because we killed our most productive sector. We need to rebrand that. There's been a lot of consolidation in there. And with that productivity growth, we're subject to the nuances of interest rate trade-offs between the United States and Canada. And because we've dropped interest rates further than the Federal Reserve, that makes me very bearish on the Canadian dollar. So your question of whether it could drop below 70, I believe it should have dropped a lot earlier below 70, but for the weakness of the US dollar by them shooting themselves in the foot with tariffs. But now the US dollar is kind of firmed up a little bit, and now we're starting to see more bearish sentiment coming out of the Canadian dollar. Until we turn around our ability to be more productive, see more business investment in machinery, equipment, software, AI, all of that stuff, I believe the Canadian dollar is going to be subject to those interest rate differentials, which, in my mind, if the Bank of Canada remains on the sidelines while the Fed is still higher in rates and even making overtures to increase rates because of inflation, the Canadian dollar will remain in a bearish trap.
Fair enough. All right. So I wanted to ask you about something else which is in the news, which is we're now, as we head into July, looking at the Kuzma renegotiation. And that's something that's been on everyone's radar for literally years, certainly since the incoming president in the United States very much put it on the radar when he took office a year and a half ago. What's your take on what we should be expecting as those negotiations progress?
Well, it's very difficult to know exactly where this goes. I mean, I joke around with the fact that I'm an economist, not a psychiatrist, so I don't know what's in the head of the president in terms of these negotiations. From what I've heard in terms of negotiations from regular channels, it's really not progressed in any sort of way. Diplomacy has kind of fallen by the wayside to some extent. But I think the ultimate goal is to come out with a deal that is slightly similar to the existing Kuzma, or just retaining some support for our existing industries. But again, I'm not 100% hopeful. For a lot of economists, if you look at bank forecasts, I used to be a bank economist, and what you got to do is make some sort of assumptions. So what a lot of folks are assuming is that we come away with some sort of deal that's very similar to Kuzma. And with that kind of stability created, well, we can get on with business and growth will start to recover in the second half of this year. And maybe that's the case, but as we all know, there's so much risk. One day it's on, one day it's off. If we don't have a deal, then I think Canada is in a tough position because, for better or worse, we are still joined to the hip to the United States, and orienting our trade away from the United States to make up that difference can take a while. So, I think there's still a lot of slow growth there. I'm hoping that in some segments of the market that we are, able to retain some sort of, tariff reduction in tariffs in some of our industries. But my general view is that the manufacturing sector, come hell or high water in Canada, the auto plants, everything else, there's not much room to save on that side. So we really have to work off our energy, our hydro, things that kind of drive things, and make sure that we still have the US as a potential market, but also other countries as well.
So I'm wondering about the way economists look at the economy and capital markets relative, say, to the way a traditional investor looks at it. You've mentioned the integration of what's going on with Kuzma. How well do you think economists integrate what's going on in the news in terms of political developments and whatnot relative to the way a standard mom and pop investor? Like my concern, I guess, is what I'm asking about is the extent to which the things that are on the front page spill over to the things that are on the front page of the business section and the finance section. How much does one influence the other? Because the sense I get is that frequently the two work in a vacuum. And I know that's not certainly strictly true with the economists. You already said so. But I'm wondering about your views on the way traditional investors think. How do they filter information in the political sphere? And how does that make its way to the decisions they make on the investing side?
Well, I think you can look at a very, a liquid market like the public equity markets. What that headline risk does is it just creates a lot of noise. So it creates a lot of volatility in the market. It's reactions to headline risks that kind of cause, investors to one day panic, want my money back, put it back in. This is a great thing. Watch the launch of SpaceX and the IPO, how everybody was like on the bandwagon, and then that came off really quickly. That to me is the problem with a lot of the noise today. I'm waxing philosophical here, but we live in such an interconnected world. The internet, social media allows us to find out about things that, 20, 30 years ago, we wouldn't know till maybe 10 days later on the back page of the business report. And markets, especially public markets, trade on noise, trade on news. And so that's the volatility there. And it makes a lot of people not be able to sleep at night. For economists, our job is to look through the noise. The economy, it's not perfect, but it's like a model that works with itself, and there are long-term drivers. Noise can impact that. Look at the GFC. We didn't see a big financial crisis coming. It threw the models apart. But as economists, we have to kind of look at fundamentals and discount a lot of that noise outside of the models. And so we have very definitive takeaways. If something happens with X, then it becomes Y. And we kind of look at it that way in terms of the situation. But the problem with this world, and I kind of quoted Donald Rumsfeld with this, there are known knowns and there are unknown unknowns. And when you know the known unknowns, you can model that. But the problem is when you have COVID, when you have all of a sudden the Straits of Hormuz shut down, these unknown unknowns, you can't model this stuff. So you can give a scenario, and economists do this all the time, but you can be blown away if you turn the page on the news and something else changes, which is why I come back to the fact that within the short-term noise and volatility, investing should be a long-term game, and look at your long-term earnings and where you want to be and discount a lot of that noise and trade off of fundamentals. If income is the issue and you need that liquidity, then, stock markets, depending on where you go, you might risk that away. So a GIC or, Canadian bank for, they're just basically all great. That's maybe where you want to be.
Carl, the podcast is called Make Better Wealth Decisions. If it was up to you, what advice would you give to the listeners to help them make better wealth decisions, given where we are right now?
Well, again, I'm an economist, and a lot of people will say, "Oh, economists don't know how to be rich." Well, one thing economists do look at is fundamentals, and I think if you are very focused on fundamentals, paying attention to your risk and return preferences. This is a very big part of investing. We're always focused on return, but we don't understand the risk. And risk, yeah, can be volatility, but it can be liquidity risk, it can be leverage risk, all of that sort of stuff. And I think investors need to discuss those risks a lot more than just focusing on absolute returns and past returns. When you do that with your advisor, when you do that, yourself, and understanding what your needs are from your wealth, you make better portfolio decisions for the long term. Hey, it's great to, knock the lights out and get a 30, 40% in Bitcoin or, something like that. But there's a lot of speculation involved in this. And that speculation is something that I think doesn't have legs when it comes to fundamentals. And people were making bets on condos for a long period of time till it wasn't. And I think that's the whole point. Pay attention to the fundamentals, understand the risk and return, and specifically the risk on all its layers. And that makes you a better investment decision for the long run.
Carl, I want to thank you for your time today. It's been a real pleasure. And I want to wish you all the best.
Thank you so much, John, and good luck with that new home.
If you're worried about the current investment climate and your money, go to my website to book a call for personalized advice to assist you in feeling secure and protected about your retirement.